Hello, I'm Brandon Wilson.
And I'm Stephen Huskey.
We're the co-founders of Bluewater Dental Advisors, a financial services firm focused on providing ambitious, goal-oriented dentists with the tools they need to reduce stress and take control of their financial destinies.
Brandon and I are blessed to reside full-time with our families in the Charleston area of South Carolina. When we are not helping our dentist business owner clients grow the value of their practice, we spend our time chasing around our little ones and the occasional round of golf.
Over the next half hour, aside from getting some CE credit, you'll leave this session with a greater awareness, a greater sense of control that will empower you to plan for your financial future by intelligently growing your business to maximize the value at exit. By the way, as a thank you for tuning in with us today, we're offering the first 25 of you that respond an opportunity to participate in our complimentary Biz Equity program. This is a resource we provide to our clients that allows you to have your business valued, and we'll explain in further detail at the very end what that means.
Before we dig into the content of this presentation, I just want to give you some background as to who we are. With approximately 20 years of combined experience, Brandon and I have built financial planning practices focused on helping busy, goal-oriented professionals and business owners get financially organized. While we love working with just about anyone, we've both developed a real passion for working with dentists who, like us, love their work.
Bluewater Dental Advisors specializes in educating and guiding dental practice owners, and we've developed a truly powerful 5-step process that allows them to protect, grow, and ultimately exit their practices with the kind of money that reflects the value of years of dedication and hard work. But enough about us. The focus of our conversation today is to talk about the 3 choices that we can make as it pertains to selling your business. First, let's back up and acknowledge why it's so difficult to plan for your future in general. You worked your tail off to get through medical school, and no doubt, school prepared you for the technical work of dentistry. Unfortunately, virtually no medical or dental school provides their students with the fundamentals they need to successfully manage your finances, let alone how to start, manage, scale, and sell your business. You know it would take a ton of work, no shocker there, but what we find is that when you own a practice, you tend to get laser focused on doing what it is that you do best, taking care of people, specifically their teeth, and you put off taking control of your financial destiny.
So what happens is, financial decisions need to be made quickly and frequently. Sometimes we get it right, and sometimes we don't. We're often very reliant on the professionals around us. No doubt an accountant who gives us guidance on taxes, a banker who helped you with a loan, an attorney keeping you on the right side of the law, and financial professionals who helped put some insurance in place for you. There can be a dozen separate professionals purportedly looking out for your best interest, but there's typically very little coordination between these professionals at all. In terms of financial decision making, we've found that this can result in costly inefficiencies and missed opportunities. Fortunately, almost all of this is entirely avoidable if, rather than reacting your way forward, you can start to see your practice from the end, that is, from the exit. Simply put, when we know how the game is played and your team is organized around a common goal, your goal, then the real magic starts to happen.
All right, so here we go. Remember I mentioned that our hope was for you to leave this presentation with something of value? Here's takeaway number 1. We must come to grips with the fact that one day you're going to leave your practice, whether that's voluntarily or involuntarily, toes up or toes down, as they say. Given this reality, now we must address the second half of this equation. Takeaway number 2, there are 3 possible outcomes, 3 possible doors of exit, period.
This is very broad and applicable to pretty much anyone that owns a business.
So let's see what's behind door number 1, Stephen.
You could sell your practice to an insider. Door number 1 is actually very common in your industry. We see a lot of inside sales in the dentist community.
Selling your practice to an insider or someone that has worked in your organization can be a great way to ensure that your business continues to thrive well beyond your exit. Your patients may find comfort in being taken care of by a familiar face. Your employees may like the idea of a new leader that values the existing culture of your organization.
On the other hand, the transfer of your business to an insider can come with some inherent challenges, and it all comes down to money. Let me explain. While you worked in this practice, you collected a check, typically in the form of a salary plus some distributions paid out quarterly, semi-annually, annually, etc. When you stop working, that check stops, and now your assets have to somehow replace that income stream you were accustomed to having during your working years. Another way to look at this is to think about a bucket of money. When you retire, you'll need a big bucket of money to pull from that will last you the rest of your life and your spouse's life if you're married.
That's right, Stephen, and what we often find is there's a gap between what you actually have in assets that can generate income and the amount needed to generate the income you desire. This bucket of money just isn't big enough to pull from indefinitely without a high likelihood of it expiring before you do. Turns out that most of our clients don't like the thought of going back to work in their 80s. Fortunately, you have this nice nest egg known as your dental practice. But what we found, all too often, insiders don't have the ability to write you a check for it when the time comes to purchase.
This is where the problem comes in with the typical inside sale. Most buyers don't have the funds to write you, the owner, a check for the full value of your business. And you can't just give it to them. That doesn't help you fill up your bucket of money that you're going to need in retirement.
Darn right, Stephen. Spot on, brother. So the following is how we see a lot of these sales or transactions take place. I'm going to use a visual tool to demonstrate what is commonly used or known in our industry as an installment sale. What is an installment sale, you might be asking? Very simply put, an installment sale is when the buyer of a business promises to make payments of X to the seller over Y period of time. The way that most businesses are sold to an insider is through what we would label here as the promissory note approach. The buyer, in this case perhaps a key employee, is going to purchase the existing business from the existing owner, and they're going to do it using owner financing. In essence, we have a loan on paper. The buyer sends payments back to the seller for some period of time. So let's follow what the cash flow would look like in that sort of a scenario. For example, let's say we're purchasing, in this case, a $6 million practice over the course of 10 years. Pretty simple math tells us there's a $600,000 per year principal payment that has to be made to satisfy the agreement. In our simple example, we're not including interest, just to keep things as clear and conceptual as possible. Now, in order for our buyer to write a check for $600,000, they first have to earn on a gross earnings basis perhaps as much as $1 million, depending on their tax rate. In other words, they have to generate $1 million to net the $600,000 needed to pay the seller. When it's ultimately received by the exiting owner who has sold, they then pay capital gains tax. This method represents an extremely high effective tax rate on $1 of cash flow that's moving through the transaction. Using our numbers here on the screen, you can see that it's a 58% effective tax rate, probably the highest effective tax rate that our owner has ever seen or even considered experiencing. This puts pressure on the new owner and on the business itself to perform, because they have to come up with, in this case, $1 million of earnings just to satisfy these installment payments before anything else in the business, such as the growth of the business, is actually accomplished. For the seller, it represents a loss of control. They're now 100% counting on an unseasoned owner-operator to ultimately run this business for the first time and run it so well. The buyer has to hit $1 million and somehow make the business profitable on top of that. For a lot of owners and for a lot of potential buyers, this presents a unique set of challenges, in principle because of the pressure created by this degree of double taxation. If you're going to continue down this inside sale route, then there are a couple of additional tactics that you may want to consider with the help of your trusted financial and tax advisors.
One concept that can work in transitioning your practice to an inside person, a concept that may seem counterintuitive at first, is known as the lowest defensible value rule. In theory, you're going to sell the practice for a lower value, which will reduce the taxes for the seller. This will also reduce the amount of outlay needed to be generated by the buyer or new owner. You're probably thinking, what? Sell my business for less? Let me explain. In our initial example of a typical inside sale, we identified the problem of being solely dependent on practice revenues to generate those payments to the seller. So if there are ways around this double taxation issue, it will only decrease the pressure on both parties involved. We can do things like apply minority shareholder discounts. We could consider the strategies of lack of marketability discounts, because this buyer doesn't necessarily have the right or the privilege to sell their newly purchased shares to a third party before offering them back to the seller. Those are things that can, on paper, drive down the value of the shares for the purpose of this purchase on the part of the buyer. There's also an opportunity to lower the value on paper from a transaction standpoint with the implementation of deferred compensation. Deferred compensation is a promise to pay a certain amount to the exiting owner, in this case, at some point in the future. if the business owes a certain amount of money to the seller in the future, the amount owed sits as a present liability on the business's balance sheet. This liability will lower business value, which once again helps the buyer. Now you may be thinking, aren't these things hurting the bottom line of the seller? Which is true if this is all you did. Brandon, why don't you give them the rest of the inside sales story?
Happy to. So at the end of the day, we have to make the seller whole again because they need to be able to retire and travel and buy the boat and play golf. And they deserve to reap the benefits of their life's work and the blood and the sweat they put in their practice in building it. We're going to do this through direct payments from the practice. These payments can take different forms, many different forms. It could be, in fact, that deferred compensation agreement that we referenced earlier. Those payments would flow directly from the business to the seller. And when that occurs, it's only taxed one time to the seller. This payment can be tax deductible to the business when structured correctly. And what does that do? It lowers the amount of total cash flow required to execute the business transition. Less cash flow required means less risk for everyone because there's less pressure on the business to generate a certain amount of earnings every year. By the way, it can be structured in such a way that the seller doesn't have to give up control until the very last shares have been transferred. Everyone is made whole and they can now all move on with the next phase of their life, retirement, perhaps for the seller, and the ability to really now run the business and try to grow it on the part of the buyer. Win-win. In all cases, it's important to not forget that there's still business risk associated with a transaction. That being said, you should look at structuring and funding a buy-sell agreement in case something were to happen to the buyer or the seller before the terms of the agreement are satisfied. We recommend that you get with your trusted financial and tax advisors for advice on how to properly structure your inside sale should this be the door of exit you choose. On to door number 2. Stephen, do you mind telling us what's behind door number 2?
Sure thing, Brandon. The second door we can walk through to exit our business one day would be the sale of our practice to a third or outside party. When you think third-party sale, think about a financial buyer who has resources. Think about a strategic buyer that looks at your business and sees value that your business can add to their existing operation. In your industry, this outside buyer could be another dentist business owner that is in private practice and looking to expand their clientele geographically. They may be looking to grow through the acquisition of additional offices, which should bring with it added revenue to their bottom line. And although more than 90% of dentist practices in America are still 100% privately owned, a somewhat growing trend is the third-party buyer that comes to you in the form of a dental service organization or DSO.
That's right. Exiting your practice via the sale of your ownership in it to an outsider has a few obvious advantages. This outsider is generally going to write you a check and close on the sale much quicker than the insider sale method. Given that they typically come to you with funds in hand, they don't need your help or financing in making this transaction happen over time. Although many third parties buy businesses and hire the seller back in some form of a consultant role for a transitional period of time, that isn't always the case. So another possible advantage to choosing to exit through this door could be that you're able to fully stop working the day after the check hits your account. Notice that I didn't say fully retire.
On the flip side, choosing to sell your business to a third party has its disadvantages to consider as well. One of those is loss of control. There may not be the continuation of the company's current family feel or culture. If not planned for and communicated properly, your current staff could decide to jump ship. And just as important, there has to be close attention paid to the net proceeds this third-party sale generates to the seller. We can't forget that the take-home number isn't the number on the check we receive at close. And before we agree to a sale price, we have to be aware of what that translates to in net proceeds.
No doubt, Stephen. Spit the truth, man. Let me expound. All businesses are valued on cash flow. Although you as the owner may have some really nice assets on your business balance sheet, such as dental x-ray technology and equipment, or a free and clear piece of prime real estate that the office sits on, at the end of the day, your buyer is acquiring you because of your cash flow. The cash flow that your practice generates is the reason you got into this business. It's the mechanism that has allowed you and your family and your employees and their families to live in the world they are currently living. When you get ready to sell, you have to understand that you are selling the cash flow of your business, and whether you, the seller, are going to fully retire or move on to some other venture, we have to replicate some semblance of that cash flow that you were accustomed to before the day you sold your business.
So let me use the example of a practice owner whose practice averaged around $2.8 million in revenue per year for the last several years. This person gets a call one day from a third party looking to buy a private practice in their little town of Mayberry, USA. This third party buyer throws out a number of $2 million based on a very simple valuation method of 70% of the practice's gross revenues that the third party was able to dig up on dentistryIQ.com. Mrs. Business Owner gets to thinking, wow, $2 million, that's a big check. The husband and I have always talked about that trip to Africa, and I did just see that beach house we've been dreaming about go on the market for what appears to be a very reasonable price. And I think we could talk them down even lower on the price. The kids are out of the house, and grandkids should be in the equation anytime now. I am getting older, and although I still love what I do, I could also love not having an alarm clock wake me up in the morning again, ever. Dr. Smith, as we will call her, tells this third party she will call them back within a few hours with her decision. A few hours later, Dr. Smith calls these folks back, and without very little thought to her decision, decides to pull the trigger on the offer. You only live once, she tells herself in the back of her mind. Great, the third party tells her. We'll be in touch within 24 hours to discuss next steps.
But let's fast forward and play out what actually happens in real life once Dr. Smith collects this check, walks out of her practice doors for the last time, and enters retirement. First off, all the $2 million is not hers. There's this immediate wealth eroding factor, as we'll call it, known as capital gains tax. Let's assume for a minute that her accountant did a great job year after year of helping her find deductions and depreciate equipment as quickly as is allowed by the IRS. This is all great when you're able to avoid paying taxes in the year you claim these items. On the flip side, this gives her very little basis in her company, which means the IRS will get $300,000 of the $2 million. That's 15% of the proceeds of the sale. That leaves Dr. Smith with a bucket of money to pull from in retirement of $1.7 million, still a lot of cash. But remember, she owned her business because it was really good at producing cash flow. And that cash flow resulted in her being able to pull a salary for herself of $150,000 per year the last several years, plus another $50,000 or so in distributions. Stephen, please show us how that $1.7 million actually equates to cash flow, or a paycheck for the Smiths, in other words.
So there are rules around how Dr. Smith will need to handle her retirement nest egg, or her $1.7 million account, in other words. Obviously, no matter how well she invests it, she can't start taking out huge amounts of the total in the first year or two without running the risk of it going backwards. The likelihood that Dr. Smith, who's 63 years old by the way, lives well into her 80s is pretty high. That's 20 plus years of needing this money to provide income. There are also other risks to account for that could cripple this account, such as inflation. There's the risk of Dr. Smith needing some sort of care in her elder years. So what does this $1.7 million actually do for Dr. Smith as far as income? If we use the standard typical withdrawal rate of approximately 4% that is commonly taught in the investment world, you can see that that produces an income stream of roughly $65,000 per year for Dr. Smith. And that's before taxes. Take out some taxes and now she's forced to live off of $52,000 a year. Now to be fair, we haven't included other income sources Dr. Smith may have at her disposal, such as Social Security. However, that is still a far cry from the $200,000 per year she had been paying herself pre-sale of the practice. How do most retirees in a situation like Dr. Smith make this work? They either scale back their lifestyle by spending less, or they don't do things like take that dream trip to Africa, or they violate the golden 4% withdrawal rule and invade the principle they are relying on to generate income indefinitely. Neither of these are desirable, but they can be prevented with proper planning. By the way, we know that we're using a very conservative numbers in this example. Y'all make more than Dr. Smith.
Please note that we're not suggesting that exiting your practice by selling it to an outsider or third party is a bad idea. We're also not trying to insinuate that Dr. Smith made a bad decision. There are many other factors to be considered that would dictate whether or not this was a financially wise or financially not wise decision. Our advice simply is for you to get with your trusted advisors and establish whether or not an outside sell makes the most sense for you and your business. And if it does, please start planning now, since we always want to begin with the end in mind.
Woo! 2 doors down, 1 to go. So if we don't intend on selling our practice to an associate dentist that works in your business, or we don't intend on eventually selling it to a third party, then what is our third door, Brandon? You're telling me there's another option?
Yes, Stephen. That's exactly what I'm telling you. On to door number 3. The final option is to keep ownership until the day you no longer can be a dentist business owner, whether that be due to death or you simply get to a point of no longer being able to practice due to your health. Before I go into this door, I want to first point out that this is your business. This is your baby to build as you see fit within the grand scheme of your overall goals and legacy wishes. Now, this option may carry a negative connotation, but at the end of the day, if you spend your life's work helping hundreds, maybe thousands of individuals have better dental health for decades than they would have had they not met you, I'd venture to guess that's still a pretty positive impact to the patients you served.
True, Brandon. This is indeed your practice to build and one day leave however you see fit. One of the few advantages to choosing door number 3 is that it requires little to no planning. Unfortunately, statistics from TheStreet.com show that 66% of business owners that choose this route do so by default. They waited until this was their only option. In your industry, this happens even more often. A whopping 95% of dentists who own their practice fail to create any sort of exit plan, according to exit strategist William Prescott and mndental.org. For all the work that you put into this business over decades, it seems reasonable that you deserve to receive some value for all your blood, sweat, and tears. Whichever of these 3 doors you choose to walk through, there are universal truths that apply to the way you plan today and in the future that will determine your retirement and the legacy for those with which you wish to share it. Each path requires proper planning around a number of areas, including cash flow, attracting and retaining the right people, continuity planning, protecting your business asset, and more. Okay, so let's close door number 3 and take a look at a business balance sheet approach to show how all these areas fit together.
Obviously, we want to grow our assets and minimize our liabilities. And the mechanism to do any of this is the lifeline of any business, cash flow. Without cash flow, there are no assets, there are no liabilities, there is no business. When we talk about growth, all businesses grow through people. We have to have the right individuals on the right seats of the bus. That being the case, we should offer great financial incentives or packages to attract the best folks for our organization. We can do this through things like group insurances, a good retirement plan, well-structured paid time off. These are just a few examples. Then, once we find these key people, we want to create ways to retain them and create excitement around helping you grow your practice. You may decide to implement some form of an incentive bonus tied to top-line revenues. There are also plans like a deferred compensation arrangement that you can contribute to on their behalf that grows over time. As long as they stay with your organization for a predetermined period of time, they will receive the payout from this plan. The key words when we consider growth are attraction and, just as important, retention.
I think we can all agree that your business and the cash flow it generates is by far your biggest asset personally. It not only provides for you and your family, it is the provider of paychecks for those that work for you and their families. That being said, we can't afford to not properly protect against the real life things that can and do go wrong and happen to good people. People get sick, people get divorced, people get sued, and people die. We must have properly structured legal documents like a buy-sell agreement. A simple way to think about this strategy is to call it a will for your business. We encourage our clients to have a buy-sell written up by a business planning attorney and to fully fund it with the appropriate insurances. Those key people we mentioned earlier are also very hard to replace. We need to have plans such as a key person life and key person disability to protect against the loss of a key person. As the owner or owners of a dental practice, we need to ensure that if you can't practice due to an injury or sickness, your overhead continues to get paid. And there are plans and strategies around those types of protections. We encourage you to get with your trusted advisors in each of these respective areas to assess what proper planning looks like for you based on the uniqueness of your practice and your goals.
So here are the key takeaways we hope to have driven home up until this point in the presentation. we have to begin with the end in mind. Whether we are the owner of a newly acquired dental practice with another 20 years of work ahead of us, or in our early 60s and eyeing retirement, the day will come when you leave your business. That eventual exit is inevitable, so we should start planning for that day now. There are only 3 ways that this exit will occur. We can be bought out or acquired by someone who is already a part of our practice. We call these people insiders or key employees. Most key employees that are interested buyers don't have capital on hand to write a check in one lump sum for the value of your business. This creates some inherent challenges such as double taxation on the payments from the buyer to the seller. This can also lead to significant planning opportunities as previously discussed. A third party or unrelated business entity, in other words, can buy our practice. This is typically done in a single transaction. Sometimes the seller remains in the practice for a specified period of time, usually as a consultant. Regardless, taxes on the proceeds of the sale always need to be considered so that you can do accurate planning on your retirement, legacy, or future endeavors. Lastly, we can keep our business indefinitely. This is often a default option as a result of a lack of planning. Regardless of your exit path, there are things we should consider when growing and protecting our practice. We want to attract the right people for our organization. We want to retain those that are key to the future growth of our practice. We want to protect our most valuable asset against the things that can and do go wrong. Most importantly, we want to make all these decisions in a way that makes the most efficient use of our cash flow, as it is the mechanism that fuels the ship.
Now to the fun stuff. At the very beginning, we mentioned a reward for your willingness to take time out of your busy day to watch us walk with you through the 3 doors of exit. Following this presentation, you'll receive a link for a short 10-question exam required to receive your continuing education hours. We also request that you take a quick 2-minute survey to provide feedback on our educational material. In the bottom of the survey will be a link to click and enter some generic information about you and your practice. Assuming you're one of the first 25 people to respond, a member of our team will contact you with information on what is needed to participate in our informal business valuation process using Biz Equity. We strongly encourage you to take advantage of this opportunity so that you can know the value of your greatest asset, your business. Once again, thank you so much for the hard work that you do. Thank you as well on behalf of the patients you serve. Have a great rest of your day. Take care, and God bless America.